Bitcoin finally had a decent week, pushing up almost to the 42,000 resistance and closing above 39.6, a level we've been talking about a lot. A lot of people view that obviously as the psychological level around 40,000, but things looking up, but too early, obviously, to tell. There's a lot going on in the world, so I'm bringing on Mike McGlone from Bloomberg, who always has the best perspective, in my opinion, on what's happening in the macro environment and how that affects Bitcoin. We're also going to take a look at a few charts and the rest of the news. Let us go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of Wall Street. Before we get started, please subscribe to the channel and throw something at the like button. I don't care. Throw anything you got randomly around and just keep doing it until you hit the like button. Hope all of you are having a wonderful Monday today. Sorry, I'm running a bit late. Had a bit of a crazy morning with one of those classic kid gets hurt and has to go to emergency room, but is kind of fine situation. So that's what I have been dealing with today, and the reason we're running a little late. But as I said before, a lot going on in the world. Had a decent candle from Bitcoin on the weekly, which we will talk about in a few minutes. But first, I want to bring on my friend Mike McGlone to talk macro. Mike, how are you, buddy?
Hey, Scott. It's good. Good luck with your daughter. Having raised 4 kids, that's just part of the things that get thrown at you, and you overcome them. And I'm glad your daughter has.
Yeah, if a kid isn't getting hurt, it's not Monday. Right. And it seems like if I'm not talking to you, it's also not Monday. So listen, as I generally do seemingly on every Monday, I start my day by reading, I still call it your newsletter, but that comes on Monday morning, your report, I should say. And seemingly the overwhelming theme is reversion to the mean here, right? Can you talk about that a bit?
Yeah, I think that's the way I think this year is going to play out. And it's how you define means, and that can be very subjective. I'm looking at big picture, long term, and I'm starting with the macro. My base case is this year is the year of the ebbing tide, led by the stock market, and crypto's following that. The key thing is cryptos are the most speculative, reactive markets in the world, so they're a bit of a leading indicator, and Bitcoin coming out ahead. So I'll leave you with my base case. I think the year is going to play out, and then we can knock that around. I fully expect we should get about a 1/3 correction in the stock market, and we're at the stage right now. I think people are still buying the dip. They haven't realized yet that if the stock market is going to go down, the Fed's going to just tighten more. Chairman Powell has said that, and it's also the cases of what's happened in history. These things usually happen when there's a significant stretch from a mean to go back to. 1987 was one of the best examples in history. Then we had 2000 to 2002. That was just simple mean reversion. Then we had 2008 to down to the bottom in 2009. And I think this year is one of the best cases ever. The difference with past is we didn't have cryptos in the past.
Right, that makes perfect sense. So let's talk about defining that reversion to the mean, because even right before we jumped on, I asked you that question. Is that a specific line? Is it an idea? Where is that?
So this is a part of the research that got me from the trading pits in Chicago to New York, is being able to define these kind of extreme levels starting in the 80s and then just trying to define when the market should go back to these extreme levels. So the standard 2 I'm using for the stock market are either the 60-month, which is 5 years, it's kind of standard in commodities, or 100 weeks, which is about 4 years. And the key point is S&P 500, as of a few months ago, just stretched the most above its 100-week or 60-month moving average in about 2 decades. We all know from 2000, I was trading a lot of internet stocks back then. The point is, when this happens, all it takes is a minor spark to just push it back to levels that are not so extreme. We've got that spark. 2 key sparks and that is the key statement that really struck me from Mr. Powell last was he said, yeah, I could be raising 50 basis points. And I guarantee it's having, traded treasuries for 30 years and back in the 80s, is the Fed is thinking They don't want to go back down in history as someone who missed inflation. And if the stock market keeps going up, there's a good chance they will hike 50 basis points at the next meeting. And the bottom line that I heard from Jim Bianco recently is the Fed has to stop the ability to buy for people to buy stuff or curtail that, or inflation won't go down, and that's their mandate. Number one, it's a mandate in law, and it's a mandate from Biden. And so when the Chairman Powell says, yes, we will control inflation, that means your 401k. But people don't get it yet. That's fine. But I'm sensing from professional money managers I've dealt with all my life and Wall Street, they're selling rallies. Right now, we get the average person say, oh, you got to buy the dip because that's what works because you can't fight the Fed. Well, if you're buying a dip, you're fighting the Fed.
That makes sense. So do you think that they only did 0.25 basis points this time because there was pressure from the war and they would have obviously been more aggressive, and it was just they had to do something, so they went with the smallest amount possible to not spook the market?
Oh, sure. The last thing the Fed wants to do is create volatility. You nailed it. You're going to always start with 25. That's perfect. But when Chairman Powell says he might go 50 in further meetings, that's your warning. That's all you need to know. So that's the history of having been a Fed watcher. In the past, before we had this open Fed, before Chairman Greenspan, the Fed was a closed, basically a closed society. You had to figure out what they were doing. That's what the primary dealers did. That's what I did to work for it. You just figure it out by watching what they did. Now they tell you, and he just told you. He just told us. And then I point out, okay, so we have the most extended stock market in 20 years, relatively. It's coming back a little bit. Most expensive stock market in terms of GDP in the history of mankind, and most expensive stock market versus real estate and versus global equities ever. Okay, well, there's a good reason. And part of that is that's been driving inflation, and the Fed has to push back that inflation. So to me, that's the key puzzle point that this year, that if it doesn't get filled in, i.e. the stock market dropping about 1/3, then that's going to be an issue. I won't know what to do. I might have that problem, which would be wonderful if we could just keep raising. You know, the average rent in Miami was up like 40% in a year. That's like
In a year.
Yeah. So that stuff is always indicative of mean reversion. It doesn't last forever, and then it comes back. And to me, that's what the Fed has to fight. They will fight. And the key thing is cryptos are right in there because they're great leading indicators. But that's my base case. Don't fight the Fed. And I fully expect almost all bear markets have to rip your face off. They have to make you lose hair. The best rallies, and I don't think this is going to be over until we get past that period of people realizing, okay, you can't just buy the dip forever and make money. I think we have to get to a point where people give up. It's always happened in history. It's just a question of time. I mean, what's happened in some of the major crashes in history? People give up on that buy the dip mantra, and then it's time to buy. It could last 5 years. It could last 10 years. It could last 5 months. But what we've done so far this year is a blip on the radar screen. It's nothing. And that's my point is tide has to ebb, or the Fed will make it ebb. If they get through this period without the ebbing tide, great. That would be wonderful. And I do fully expect Bitcoin to come out ahead, but I think we're early days of the storm.
Me too. The interesting conflict there is there's a midterm election in November, right? They can't let it, I guess, crash if you're the incumbent, right? I mean, if the stock market goes down 30% before November, everybody loses their job.
Well, that's the key thing. They're already going to lose their jobs, the Democrats. I mean, it's guaranteed. They completely messed up the inflation in energy. I mean, it's one thing I have, being completely apolitical, that's one thing Trump got. Drill at will, keep prices low, people are happy. I was completely, and Mr. Biden gave a great State of the Union, but he missed one key thing. You know, this country has the ability to produce so much energy. If you just, turn on the taps. And with Canada, we will anyhow. We're crushing it with excess of surplus of energy versus demand. I mean, the largest exporter of LNG on the planet is the U.S., and that's what Europe needs. And that's only mostly because the U.S. is adopting that technology and has less restrictions than the rest of the world. But I think that's one thing that Mr. Biden missed, and trying to get more energy from Saudi Arabia and more from Venezuela. But it's also the macro that wars are fought because of energy in history. Why did Japan invade Pearl Harbor? It's because the U.S. had cut off some of their ability to get crude oil. It's just what happens. That's completely changed. And the U.S. is going to crush this environment. I think this is the beginning of the next decade in century. The U.S. is just going to come out ahead. That's one thing I love to point, and I love to dig into that later. I point out 10 reasons why China's peaked, Russia's peaked, because they're fighting the 20th century. The U.S. has moved to the 21st century. A lot of that is energy. But even without major impetus from, I think the U.S. will be the arsenal of democracy for commodities. Even without that, we'll still do very well by having the largest exporter of agriculture on the planet, largest exporter of liquefied natural gas on the planet, and with Canada, a massive exporter of liquid fuels, which means crude oil.
Does that mean that what's happening right now actually could be a trigger for that American dominance long term, sort of a short-term pain, long-term gain, because it takes Russia out of the equation?
Oh, completely. So Russia's economy is going to completely collapse. They're fighting a war of the 20th century with knives, and the wars of the 21st century are economics. This narrative about the U.S. cutting them off from SWIFT, rip the Band-Aid off. My thought is you can't look back from the future and say, I didn't do anything to help prevent what they're doing. I mean, what's next? I guess it's kind of ingrained for me. I'm Lithuanian on my mother's side, and my ancestors left the Bolsheviks. They just had to get out. Same. It's happening now. The Baltic states are next. There's Poland, there's Germany, the whole area down. I mean, next time Mr. Putin gets upset about anything, either way, that's what's changed. Europe's at war. Europe has a major aggressor, and they have a major issue. And then you turn and they have major issues with commodities and their economy. And then you look over to the U.S., massive excess producer of all commodities. Adopting technology. Crypto is a good example. China pushed back. China's been pushing back on cryptos. We know we've done that. They push back on free market capitalism. It's going to fail. It always has when you don't let free markets and free market flow determine what to do with markets. Hong Kong has completely peaked, things like that. And the U.S., by not messing it up, by our sloppy system, will crush it. So I like to point out when people say, we're like Rome. Well, Rome lasted about 1,000 years. We're 300 years in. And to me, that's what's happening now. This changed everything. And crypto is a key part of that. The U.S. is adopting it slowly, but the exact opposite of China, who can't keep up with their system. Why has China tried to launch a CBDC? Because it's already happened organically with the dollar through crypto dollars. That's already a done deal, and the U.S. is probably just going to regulate that properly. And then you have Russia, who's basically the gas station for the world. In 10 years, we're not going to need it. In 5 years, we're going to need it less. I drive an electric car. It's solar panels on my house. Consumption in the U.S. has been declining for all fossil fuels, and production has been blasting off. Farm background, ethanol. 40% of the crop now is used for ethanol. So to me, those are trends that people are missing, and you don't usually catch the inflection points. And the property issues we're seeing in China are just part of what's the beginning of an economy that's trying to be managed by someone who's called a president who's actually a dictator. It just doesn't work.
Yeah. I have a comment over here before I let you go. Love the new format, but Jeff said the Great Reset. Is that how you see this?
Oh, yeah,
obviously,
absolutely. Completely the Great Reset. And it's one thing that happens sometimes in history. You don't realize it until afterwards. And my job is to try to predict that ahead of time. So to me, this is a Great Reset that tilts the whole world for us. So I ask the question of our audiences, what person on a board of directors in any country on the planet who imports from China is not having the discussion, is there a better way to do this? They have problems with lockdown. They couldn't control the virus because they had all these great viruses that were not created in free competition. Turned out that didn't work. They have a president who's a dictator, and they're anti-U.S. Okay, and their costs of production's increasing, their economies, their population's declining. It's all negative. I mean, taking all those people from poverty and bringing them out, that worked. Now the whole world is going away from that supply chain completely. What was their source of revenue? Sending products to the rest of the world, completely gone. Just a matter of time, the rest of the world uses technology, Jeff Booth example, to replace that. And now it's got the major impetus that they backed Russia. They did, unfortunately. And the rest of the world has realized, okay, pull the plug in Russia, because if you don't, what happens? You have to cut them off completely economically. We have to take the pain, but it's better than people like my son, who's a captain in the army, going there and dying for these lost causes.
Yeah, so hopefully they bet on the wrong horse. The premise there.
Well, it's almost a guarantee they did. And I think they realize that, because what are you going to sell to Russia? Their economy is going to be crushed. What are you going to sell to the U.S.? Do you want to hurt your best customer, or do you want to help your best customer? Europe's going through recession. It's very simple. If you're a supply side economy, which China is, you got no choice.
So we got to be looking for basically a 30% downside on the stock market. When you look at 30% downside these days, do you think about Dow, S&P, or NASDAQ?
S&P.
Because we're seeing them
Yeah.
massively different these times.
Well, NASDAQ is the most highest beta. So when I say stock market, S&P 500, and that's the key thing. On a global scale, there's no more significant benchmark for any asset than the S&P 500. It's a lesson I learned working at S&P, but it's a fact. When the S&P 500 goes down, that's all that matters. If it goes down with high velocity, it matters more than anything. And that has, to me, just getting started. Now, this happened in 2008. I have to admit, that was one of my best trading years ever, only because I was hedging myself with S&P puts. And you have to do that carefully, because the lesson in puts is they expire and then the market goes down. But we're at the stage now. You have to get over that psychology. Even strategists, most of them are saying buy the dip. Great. That's usually how it works. But the Fed has said sell the rally. They told you to sell the rally. And the point is, the Fed, I'm just putting myself in, to me, it's one of the most important things I have to do is put myself in the human nature of the decision makers and the market. My sense is, if the stock market drops down and reduces the ability for people to buy stuff, problem solved. If that doesn't happen, bigger problem. We start hiking 50 at each meeting until that happens. So the simplistic thing for the stock market, everything to solve the puzzle of the world right now of the highest interest rates in 40 years, the speculative X's in cryptos we saw last year, things like Robinhood, is for the stock market. And I say about a third because we did see the 20% correction in the NASDAQ. It didn't matter. And here's a key fact. Exactly. The last time we had a similar correction, the Fed was priced, we talked about this a little bit. In a year, Fed was priced for about 24, 25 basis point hikes. Now, we're priced for 25 basis point hikes in the next year. And that's despite the fact we've already had a 15% drawdown in stock markets. Come right back. And that's the problem. Every time the Fed sees that stock market to go up, price in more hikes. It's the lose-lose.
Yeah, and it begs the obvious question is, what the hell do you do with your money? So yeah, okay, you sell the rallies. Obviously, I think you say a lot of money managers doing that. I mean, are we back to buying 30-year treasuries?
Yeah, so I do like that. So that's key. One of my key factors. I have to admit, I'm a contrarian there, and that's why sometimes the best investments in history are when you fade the consensus. I have not, as far as a 1 to 10, maybe a fraction of 10 strategists said it's okay to buy long bonds. I like long bonds. I like gold. I like Bitcoin, partly because they're contrarian, other than cash. And the key trigger is you basically need the stock market to stop going up to get into gold. I think Bitcoin's part of that, because to me, you can't have gold without Bitcoin anymore unless you're, living in the 20th century. And long bonds, I think, are already pricing in for that future of the base effect, meaning inflation can go up so much and then it has to go down. Number one, by the rules of economics, by the rules of the higher price Q, and now you have the most aggressive, emboldened Fed almost in history. Mr. Powell's been reappointed. He's pointed out he's viewing himself as how the world will judge him 25 years from now. And if he goes down in history as a person who let this inflation run rampant, then that misses his goal. And he just said it in the last meetings, that little trigger. He said, yeah, we could go 50 in further meetings. That was my warning, that people didn't get it yet. Yeah, go buy the dip. I'm like, that's just I think for the people who haven't learned their lessons that some of us have learned by being around for almost 6 decades.
But I keep saying before I let you go, but people keep asking questions. I hope you've got like 2 more minutes.
Oh, please. I've got time this morning.
Can Bitcoin go against macro markets?
It is. It's already started. So that's one thing I love at Bitcoin. I look on the screens right now, NASDAQ down 12%, Bitcoin down 10%, yet it typically trades 3 to 4 times the volatility of NASDAQ. It's 3 to 4 times risky. The key point is its volatility versus NASDAQ has been going down over time. I think this is a defining moment, but here's the way I see Bitcoin right now. If you buy it around 41, I think 510, maybe less than there, as you fully should expect it to go around 100. But at these levels right now, we might easily see 30 first. And I fully expect that's kind of the risk reward, because 30 has been the key support. If the tide goes out, which I expect in equities, fully expect Bitcoin to drop with it, gold to continue outperforming, and then Bitcoin to gold to come out ahead. Now that's a scenario. Now, if I'm wrong, the stock market just keeps going straight up again, yeah, Bitcoin will outperform like it has. But if it does that, that's the problem. The Fed has to hike more and has to stop, as I said, as Jim Bianco put so well, has to stop the ability for people to buy stuff. If they don't, inflation will continue to rise, and we're at that point. They have to do that. key thing about cryptos is they've been, they're the speculative excess example of the future. They can trade them 24/7, 18,000 of them. You know what happened in Shiba Inu and things like Doge. That's just silly. But Bitcoin is the gold in the space, and it's still speculative. I just fully think it needs to be shaken out a little bit and then go back up as a whole market. I remember in 2008 we had a couple good bounces, and then it finally went down. And I don't see how we're going to get away from that because the Fed was easing. Now you're even fighting the Fed, and we weren't fighting a war, which we can see now in this war. What's happening with Russia sending in missiles from the mainland? It's scorched earth. We have the equivalent of, it'd be wonderful if it just ends like the Battle of the Bulge, and I'll go back and say sorry. That's the probability. That's so low that you got to rope in the war, you got to rope in the Fed, and then I still see the stock market at some of the most elevated levels in history. Gosh, it would be wonderful if we could sustain that, but it's just you look back from the future, I just can't see the narrative where that can last.
I mean, you talk about the idea that people need to be able to have to stop being able to buy things. I mean, if you look at luxury goods right now, it's absolutely insane. There's not a price raise that luxury brands, they can literally raise prices as much as they want and tell you that you can only buy 1, 2, 3, and people will pay whatever that price is. I've really never seen anything like it. I mean, returning a used car and getting more money than you paid for it 3 years ago, or going to buy a handbag and it doubles in price in 6 months. I mean, it's really insane.
How sustainable is that, Scott? I'm glad you pointed out. I look at what's
sustainable. I mean,
I look at that as the stories we'll tell our grandkids. That was your sign, and they'll say, "Grandpa or Grandma, why didn't you do something about it?" That's why my thought is, it's the risk. The greater risk is not doing something and looking like an idiot. And my sense is, from my old school connections on Wall Street, been around a while, is the pros, the people who run the real money, they're selling rallies. And the amateurs are buying dips, and I just wish them luck because, you've seen the pain in the market, and especially when you come to the trading pits, you see the real pain, which means the 2 Ds, death and divorce, and things like that. And I don't want to see that. That's why I think it's my duty to warn people. There's certain times you're supposed to just try to not lose money and don't fight the Fed.
Here's a great question to that end. When you say don't buy the market dip, is this even if you have a 20+ year time horizon?
Well, okay, that's a great question. Yes, just be willing to take a 1/3 drawdown on that. And yes, 20+ time horizon, you're always supposed to buy to scale in. Absolutely.
Yeah, you don't stop dollar cost averaging because you think something might happen. In fact, then you will miss the dip.
As long as you're willing to lose a third, which third's easy. I mean, history, third's nothing. 50%, that's kind of normal, but I'm trying to be more conservative. But you have to make sure you're not going to hit in a stop if you go below a third. Because that's what happens typically. People say, buy the dip. They buy the dip, and then, like I to me, the key thing is that is the narrative that trickles down to 6-year-olds now. It's sad, but it's true. And the problem is the market's the most overweight people, the average person in this country, most overweight equity market in history. You can go back down like a percentage of liquid assets, and that just makes sense when you have a rally like this. And the mantra is, but don't fight the Fed and buy the dip. The point is, there's a lot of people who should not be overexposed to the equity market are without trying. And that's how history will, and just human nature and mean reversion will never change. And that's what I see right now is anytime I see these rips, and you're supposed to get the biggest rips are in bear markets, I look at more as the tactical trader. Yeah, okay, look to buy the dip, but make sure if you do get that normal correction, which every time in history, you're not selling it. You have to be willing to have iron hands.
Awesome. Mike, thank you so much, as always, for joining. I'm going to see you in 2 weeks.
Looking forward to it.
See you down there in Miami for the Bitcoin conference. I love the perspective. I mean, I know you say it's contrarian. I just think it's rational to think this way. I mean, at this point, I think it's about viewing and understanding the potential downside, whether it comes or not, and knowing how to preserve and protect your capital in that situation. Worst that happens is you miss a little bit of upside.
Well, that's it. True. I mean, it's just also, I just look myself as, things change. This is a 40-year change where I try to put myself in the mind of the Fed. And every time they see the stock market go up, my first thought that they're thinking is, okay, we got to raise rates more. Yeah. It's not that complicated.
Yeah, absolutely. Thank you, Mike. See you soon.
All right, cool. See you.
Hey guys, so listen, I want to address something really, really quick that I meant to talk about at the beginning. So obviously, as you guys know, the newsletter has gone completely free. The problem is that there's an issue for people who were paying to cancel said newsletter, apparently. So what happened was when it was a paid newsletter, and the platform was not prepared for this, even though we had discussed it. So with the newsletter, the paid members could always go to the bottom of any paid newsletter, which you should be able to. So do this, go back to an older one and manage subscription and cancel. I need everybody who is paying to cancel so they don't get charged. But when a newsletter comes that's free, there's only an unsubscribe button and not a cancel button. So people have been unsubscribing instead of canceling, apparently. I'm looking at it right now. So we have all these paid members that have been unsubscribing on accident, thinking they were just canceling their membership. So what I'm asking you to do is go back to an old one, manage your subscription, and cancel the payment side, but don't unsubscribe. That's A. Or B, I'm working with Review to write a script. Stripe, who's the payment processor, will not allow you to eliminate the payments. People have to do it individually by law. And so it's re-upping people for something that is now free. So we're trying to write a script to cancel everybody en masse, but that's going to take a few days. My God. Well, subscribers aren't even down that bad. I'm just saying there's a lot of paid people who are unsubscribing, thinking they're canceling their paid side. Kill me. Yeah. I've tried, says there's a problem. There's a lot going on here. Worst that happens is you guys get charged $15. If you're super angry, I will manually go and refund it. But like no good deed goes unpunished, right? I'm like, let me make this free. And it's just caused me basically hours of customer service. Because now that I made it free, I can't send an email to paid subscribers. It's not an option. It's the system. Yeah. So let me figure that out. But anyways, guys, let's dig into a bit of news, but I do have to go pretty soon. HubSpot hack leads to data breach at BlockFi, Swan Bitcoin, NYDIG, and Circle. It wouldn't be Monday if our data wasn't being leaked on the dark web to a bunch of hackers and criminals, right? This happened through HubSpot. They use it for marketing. Your coins are safe. Most of your data is safe. But if you're using any of these platforms, I don't know, go search the dark web and see if your information's there. Malaysia ministry proposes legal tender of cryptocurrency. This is kind of interesting because Malaysia has been somewhat aggressive against crypto in the past, but now they're talking about, we hope the government can allow this. We are trying to see how we can legalize this so that we can develop youth participation in crypto and assist them. I don't know. That's what we got there. Continuing on, traders bet on Ether staking after ETH 2.0 upgrade. Ether staking yields are likely to be in the range of 10 to 15% following the upgrade. The upgrade is coming soon, guys. The merge. We're going to merge. It's going to happen. Right? So this is coming soon. And along these lines from EIP 1559, we've seen now 2 million ETH burned. Is that right? $5.6 billion worth. That's a lot. I even wrote about it in the newsletter today. I said, burn, baby, burn, like the Disco Inferno. Yeah, 2 million ETH. 2 million ETH have already been burned. It's becoming deflationary at times, even more deflationary than Bitcoin. Nobody wants to hear that. Yeah, nobody wants to hear that, but that is apparently a thing. And so now with the merge coming, people are starting to think that we're going to get 10 to 15% yields by just staking in the contract and becoming a part of the POS to the POW. Be a piece of shit. Proof of stake. POS. I still can't get over the fact that we allow it to be called POS. Continuing on, FTX launches service in Australia. Australians could already use the main FTX service to be real, but in classic FTX fashion, they're trying to get ahead of regulations and scrutiny by complying in advance of getting in trouble. It's pretty amazing. And so now FTX Australia has its own platform that will be completely compliant with future regulations. Finally, Indian crypto tax policy to treat each digital asset investment independently. The other headline that I read about this was pretty awesome. It said, India views crypto like lottery, right? They tax their lottery basically at 30%, casino, gambling, betting, all those things. That's how they're treating crypto stocks. Indians pay 0 to 15% taxes on that, but they're treating crypto here like it's a gambling asset. Maybe depending which ones, I think. Maybe. Yeah, I think that could be reasonable depending. This is good news if you were expecting India to ban it. It's bad news if you hate taxes. Let's take a very, very quick look at the Bitcoin chart because we haven't done it yet.